Hi, everyone. Thank you for joining us for today's Insight and Outlook webinar. My name is Anu Gagger. I am a capital market strategist with Fidelity Institutional. My team and I crystallize and share the best of Fidelity's insights from across our asset management, research, and investment thought leadership teams with Fidelity's institutional and intermediary clients. Before we get started, I'll go over a few housekeeping items. You can download resources related to this webinar by clicking the resources button at the bottom of your screen. There are several more resources and insights available on our website, institutional.fidelity.com, so be sure to check that out. I'd strongly encourage you to fill out the survey available through the event survey button, again at the bottom right of your screen. We use your feedback to make future broadcasts more tailored to the information that you, your clients, are looking for. So we would greatly appreciate any and all feedback. As a reminder, this is a bi-weekly webinar series that you can expect from us throughout the year. So don't forget to sign up for upcoming sessions. We try to bring you insights on timely topics and provide strategic guidance that can help you as you allocate assets. Now, we have a lot to cover, so I'd like to start by introducing our guest speakers for today's webinar on AI's impact across sectors. Clayton Steele, Portfolio Manager and Global Industrial Sector Leader. Priyanshu Bakshi, Portfolio Manager and Global Technology Investment Sector Leader. And Pranay Kirpalani, Portfolio Manager and Global Utilities Sector Leader. Now, markets for the most of the last 3 years have focused on AI hyperscalers, all the CapEx spending that they're doing and expected to continue doing, probably on an even more accelerated pace. Yet, we all know the impact of AI goes well beyond the hyperscalers, the large cap tech sector, and maybe even the US. So between the three of them, Clayton, Pri, and Pranay, have a wide swath of the AI ecosystem covered. So we couldn't ask for a better panel to help us assess the broader impact of AI across sectors. So without much ado, let's get right into it. I'm going to start with you, Pri. The recent software sell-off marks a dramatic shift in the AI narrative. Not so long ago, the market was debating whether AI was real or a bubble. And today it seems like there is an active threat to several business models. So within tech, is there a particular industry that you think is uniquely positioned to benefit and one that may get disrupted from the rapid evolution in AI?
A great question. I would say that that's true for any major new technology cycle that starts. And that was true for the start of the internet, where there were a lot of businesses which were disrupted. And ultimately, there were businesses that lost out, but new businesses came up, and they've been huge winners, and that's going to happen with the current cycle as well. I do think software will change. It doesn't mean that there won't be companies which will be massive winners in software, but definitely there'll be a lot of disruption. What is also true is that software will have to change the way it operates. It will have to very natively integrate Gen AI in just the way it functions. It can no longer be just writing one set of code and selling it 1,000,000 times and making 80% gross margins, because generative AI can really break down that mode quite easily already, and even more so if we look a few years down the line. So we'll have to watch very carefully where the winners are, and clearly companies, whether it's Anthropic or Google's Gemini or OpenAI's ChatGPT, these are the frontier model companies which are essentially probably going to be integrating with a lot of software companies, and maybe some kind of a tax will have to be paid to them to make software work. But to your question in terms of which subsectors can benefit, we are still in the AI build-out phase, and semiconductors, power, other infrastructure are still very well positioned to benefit over the next several years. I would say memory, compute, power, and this is something Pranay and Clayton can talk about. But these are subsectors which can probably benefit for several years.
Great. So just like with any other disruptive cycle, creative destruction happening along the way, and you highlighted a few sectors. Some of them fall under Clayton's radar. So Clayton, I'm going to turn to you. What is the primary attribute you consider when you're investing in companies within the industrial sector? And how is AI currently impacting that attribute?
Well, thank you for having me. And I would say that the number one metric we look across industrials, and remember, industrials is a wide range of businesses from aerospace to services to electrical equipment. So kind of the North Star that we use is free cash flow per share. And what is the impact of AI on that? It really varies by end market by end market. I think a good example right now is electrical power equipment. And we'll get to Pranay in a bit, but if you think about the demand for industrial gas turbines, we're going through a cycle that hasn't really been seen since the last major cycle in the 2000s, early 2000s. And the lessons learned from that cycle when that crashed was you really want to have good solid down payments and good cash flow up front in case there's something on the other side that moves in the other direction. And so what we've seen within industrial gas turbine companies especially is 20% plus down payments and really helping free cash flow to build out this next leg of the infrastructure build going forward. So that's one where I'd say the free cash flow is actually very much helped by this industry. And, I'd say it's too early to see where the free cash flow has been detrimental. As these start to proliferate, though, we'll have to start looking out for that. But, I would say for now, it's really the AI infrastructure guys who continue to benefit from a free cash flow per share basis.
Great. So turning from a catch-all type of sector to one that is considered a slow-moving defensive sector, something that you own when maybe the economic race starts to get a little tougher. So Pranay, after a long period of stagnant growth, the utility sector is suddenly sprinting as it goes through a seismic shift. So can you talk about why that is and what the future may look like?
Yeah, the background here is really fascinating because you basically, prior to maybe 2024, power demand had basically been flat for about 20 years. So you had just sort of modest increases in population that was kind of getting eaten up by sort of power efficiency. And AI is kind of a structural game changer with respect to power demand because AI compute is extremely kind of power hungry and you need long periods of non-interrupted baseload demand. So it really has been a step function change for the utility sector.
Awesome. So Clayton, you've written about AI, robotics, IoT, and digital twins in the recent paper that you wrote, Embracing Factory Automation Disruptors. By the way, for our audience, each of these portfolio managers, they have written pretty interesting thought pieces. So do check those out on institutional.fidelity.com. So, between all of these sectors or subsectors that you highlighted in your paper, which of these technologies do you think would make the biggest difference in the next few years?
Sure. I think that the fact that they all blend together is the interesting aspect, but let's take AI from an angle here. And, we have companies, a good example is truck brokerage, where there's a bunch of people who are still on phones putting together shippers and truck drivers to connect load hauls across the country. Being able to automate part of that is less of a labor savings and more of a productivity, standpoint where these folks can now do, way more loads, significantly higher numbers of loads with the same amount of folks. And that allows them to build out their networks and the network impacts of that business. And so I would say, kind of in those services businesses, that's where you'll see the technology impact the most going forward over the next 3 years. But then as we get into new design phases for new products, I think that's where digital twins will become really interesting. Aerospace is a good example of this, where any new aircraft takes billions of dollars, is always over budget, is years behind schedule. And a lot of that has to do with the design aspect and going into certification. And so digital twins are just starting to become a factor there, especially within the defense realm. And if that moves over to the commercial aerospace side, then I think you could see some really interesting push down in the cost of developing, new product going forward. But that's a 2030 story, to be clear. But the foundations and the groundwork are getting laid today with this build out in AI.
So even the AI, the aerospace industry benefits from all this build out in AI. So we are waiting, the market's waiting to get two big earnings announcements today. NVIDIA, a company that, through its GPUs is probably at the heart of this AI revolution. And then Salesforce, a company that many believe will be disrupted by AI. So in this tug of war between the disruptors and the disrupted and maybe everything else in between, which sector, and it could be within tech, so subsector within tech or any other sector outside of tech that is currently underestimating AI's impact?
Yeah, look, ultimately, the internet impacted all industries, and AI will impact all industries. It's just that, and like Clayton mentioned about robotics, that's the next phase. Right now, it's easiest to disrupt industries where physical work is not required or physical infrastructure is not as present. So industries with a lot of physical infrastructure moats will be more resilient, and industries which purely depend on internet, software, uh, things which can be done increasingly by AI will obviously see more disruption. Uh, and like we spoke about, uh, we still think that the building blocks of data centers, we're still in the third or fourth innings. So there's a long way to go. And whether it's semiconductors or or power equipment providers, they or cooling system providers, these companies will continue to benefit from very robust demand for several more years.
That's quite interesting. So it almost feels like we're coming back full circle when the internet came about and e-commerce. It was like, well, who needs the brick and mortar retail companies anymore? And now what you just shared with us is physical presence is becoming increasingly important.
I would add one caveat, like it's not just the traditional physical presence. Like e-commerce companies today, like Amazon, they have massive physical infrastructure. They have hundreds of thousands of fulfillment sectors, millions of people who deliver the product. So, while people like to talk about agentic e-commerce and things like that, what will be what can be disrupted is just the front end of a website or an application. But that is less than 1% of what a company like Amazon is all about. And so the real infrastructure which powers Amazon, which gets you your products in the same day or next day, that is not something that AI can do much about right now. That's still a very robust.
Great. Pranay, turning to you, your research reminds us that every AI query guzzles about 10 times more computing power than a standard Google search. Now, frankly, that's going to make me feel really guilty when I ask ChatGPT what to cook for dinner tonight. But if we are only at the starter course of AI adoption, clearly the demand for electricity for all the computations that are going to be required is going to touch the moon. So in that context, which energy source, nuclear, renewables, natural gas, which one is best positioned to support AI's insatiable appetite for electricity?
Yeah, I'm definitely in a all of the above camp, right? To kind of some of Pre and Clayton's comments that we're sort of early in a long infrastructure build out, and power is a huge bottleneck because power, is hard to scale, especially kind of given this backdrop that we have of sort of very kind of limited demand growth. And so I think that we are going to need all forms of power, whether that's renewables, gas, nuclear. Personally, I'm most excited about the kind of gas and nuclear build. We've had a long history of basically not building gas and nuclear, and gas and nuclear are base load sources. They're kind of what we call in power land dispatchable energy sources, which means that you can sort of produce electrons as needed, whereas renewables are a little bit more intermittent. So AI is going to need a lot of dispatchable resources, and I think that's going to result in really kind of strong build across kind of gas and nuclear kind of universes. And I think Clayton referenced that with respect to the gas sort of supply chain and industrial. So, I think there are some nuances, but I think if you zoom out, it feels like we're in a all of the above energy era.
Great. Now, all three of you are global investors. So maybe I'll just pose this question and any or maybe more than one of you can take this. But curious to hear your thoughts on the technological advances in automation and AI outside of the US. Is US still the best game in town, or are there opportunities to broaden AI exposure, or the exposure in companies that are building out this AI infrastructure, industrials, utilities outside of the US?
I can look. The reality is that US is the leader in AI. It is the leader in the building blocks of AI, whether it's the GPUs that NVIDIA produces. It's also the leader in the models and increasingly the enterprise use cases. But China is actually very close. And we can increasingly see that the open source models of China are just maybe 6 months behind in terms of capability. And they have been really focusing on efficiency. So the cost to serve for these models is actually lower. And so I think that it's almost becoming at this point a two-horse race between the US and China. And China is really doing incredibly well. And some of the folks on the webinar, they've probably seen videos of CDance, which is a ByteDance video generator. It can produce like really, really high quality, high fidelity video clips. Very, very creative stuff is going on. How do you play this? Well, I would say that, again, some of the building blocks are global, whether it's, the chips that TSMC produces or Samsung or Micron or Hynix, these are very global. And so as AI is adopted globally, they will all kind of benefit wherever data centers are being built.
Yeah, I would add on kind of within the industrial infrastructure portion of it. I mean, if you think about the industrial gas turbine market, and I keep going back here, but this is the core building block of the AI infrastructure build within industrials. There are three global industrial gas turbine companies. One's here in the United States, GE Vernova. There's Siemens Energy in Europe, and then there's Mitsubishi Heavy in Japan. All three of them are sold out, and all three of them are getting asked, please, can you increase capacity? But they have their own bottlenecks of forgings and castings, which also, serves the same blades that go into the aerospace and defense market, which is also, going, experiencing quite significant growth going forward. So I would say that the global opportunities rest not only in the fact that everybody is chasing this, and even if there is a U.S. leader on the AI side, the global infrastructure base is required to build out the physical assets that are required here. And so there are opportunities abroad, and it's really at this point of, who is the fastest to get things installed in the ground to get moving, where the hyperscalers need them to move.
Well, that's super exciting. Opportunities to diversify outside of the U.S. exist right now. Now, AI seems like this unstoppable freight train that's barreling down the tracks. And but my question is, what are some of these unexpected risks that you might be, focusing on, that you might be really honing in on, that could maybe derail this whole AI trade?
Yeah, I mean, I'll probably give a stab from what I'm seeing. I would say that the biggest risk still is that the companies which are leading this are still nascent. OpenAI, Anthropic, they're still each of them less than 20 billion in annualized revenues, and compute requirements that they're contracting out several years are many times that. And so while we can see initial very positive signs of the use of this technology and the real world impact it can have, it still needs to get there. It needs to be adopted at very wide scale by enterprises, and it needs to produce a lot of revenue for these companies over the next several years. That is the only way that this revolution will be sustainable. Because if not, I think the key difference between AI and the internet is AI is, like you said, extremely compute intensive. Every AI query is not a retrieval query. It actually generates that information. So by its very nature, it is going to be much more compute intensive. And so you would need to have a much greater return on the other side of that query for it to be sustainable. And we are seeing positive signs, but it really needs to happen over the next 2 or 3 years.
Yeah, and I was just gonna like in terms of power and utilities, I think that the biggest risk is, building data centers and building power is politically sensitive. And I think the question of affordability is really important. And the core question there is the hyperscalers need to make sure that the electricity costs are fully borne by them and not socialized on a household. And I think this is, something that's been in the media a lot. And, as I talk to utility executives, I think this is becoming a core priority for 26 to make sure that the only way this is sustainable from a power utility build out is to make sure that the hyperscalers are paying the full freight in terms of power generation as well as kind of transmission and distribution. And it seems like, the hyperscalers, to their credit, understand that. And so, but that I think is an open item to watch for 26.
Now, this might be a bit more specific to Pri, but any of you, please feel free to opine. But a lot of these tech companies, the hyperscalers, they used to be very capital light companies. So now you have successful executives of capital light or what used to be in the past capital light companies. And now they are doing all this capital spending. And now some of them have also come to the bond market to borrow. So how successful will these execs of capital light companies be in transforming to, operators of capital heavy businesses?
Well, there are the traditional internet companies and software companies which are capital light. But if we think about it, companies like Microsoft and Amazon and Google also operate very large hyperscaler cloud service provider businesses. And so they are in the business of making this infrastructure investment, providing the platform, and making very good returns off that. And so what is happening is that this part of their business is growing really, really rapidly. And so you can argue that it looks like their business model is changing, but in reality, what is happening is that they're really seeing once in a lifetime opportunity in one particular business segment, which will require a lot of investments, but I think they're pretty confident that there'll be strong returns on the other side.
We are getting close to the half-hour mark, so I'm going to take, we had one pre-submitted question from the panelist. Unfortunately, given the size of the audience today, we are not able to take live questions, but if there are any other questions, feel free to reach out to your Fidelity rep and we'll make sure to address your question to the best of our ability. But from the pre-submitted questions, there was one which... the question is, within the AI trade, what subsectors do you see steady growth in, irrespective of valuation? And this is for all three of you. So any of you, please feel free to come off mute.
I can take it off. And I know I'm going to be harping on industrial gas turbines this entire 30 minutes, but we'll go there again. And I think the reason for that is, if you sell a gas turbine into a data center, unlike, let's say, a piece of electrical equipment, there's a service component attached to that, right? That gas turbine is going to be running, to Pranay's point, it's baseload power. It needs to be running almost 24/7. The utilization of these means that those parts start to wear down, right? And as those parts wear down, you need somebody to come in and service them, and you need them to service them quickly because, downtime is measured in minutes and not, hours or days. And so the service component on the tail of this for industrial gas turbine companies is really interesting. And that's another place where we try to look is who has a service component to help manage the data center once it's up. So it's not just the build out that comes forward. But that's a long tail that I think is underappreciated. And then there's a pricing component on top of that, where perhaps, a utility has a different price point for maintaining its data center. But if you're for maintaining its industrial gas turbines, but if you're a data center, that price point is going to be at a different spot. So, we're very excited about, that part of the industry.
And maybe for me, like within utilities, regulation is obviously really important because a lot of these are regulated businesses. And I think what you're starting to see is that there's some states that are open for business, have constructive regulatory setups, and are kind of welcoming data centers. And other states, particularly on the coast, have a more kind of like sort of cautious view around kind of data center load. And so part of my process is trying to find utilities that are levered to kind of constructive regulatory jurisdictions. And I think that's going to become increasingly important, and you're going to start to see more bifurcation across the country.
Great. So we are getting close to the time, but I did have one question. It's a little tangential, not directly related to the topic, but just curious to hear. I'm sure our audience would learn something new from this, but how are you all using AI in your day jobs?
All right. So, well, reality is that I love using AI. It's made my job a lot simpler. Any question that I have, there's research. Like in the past, if I had to do research on something, I used to spend hours doing Google searches. Now, if you use something like deep research on Google, it can search up to 150 sources for you, really understand what you're saying, do what you want with create a chart, create a graph, and actually increasingly provide you different viewpoints and different insights. So, as somebody who's focused on research and investment, it's really been a game changer. I mean, I spend at least a couple of hours on these tools every day, just with a lot of back and forth, and it's really improved the quality of my research.
Thank you for sharing that, Pri. Anyone else?
Well, yeah, well, I'll just echo. Oh, sorry, I just want to echo what, especially with sectors that are quite dense in terms of filings. So in utilities, you have a lot of regulatory filings. AI can be a huge sort of a huge advantage because essentially, there's a lot of kind of like dense info, but there are only, in our business, there are kind of a few things that matter. And that I found is very, especially, if you're using the right tools and you're asking the right questions, you're able to kind of go through very complex documents and files and find the sort of one or two things that matter, or the one or two things that have changed, which is also really important. So.
Super helpful. Thank you so much. So, as you all heard from our panelists today, while markets continue to navigate the shifting narrative around artificial intelligence, AI will remain a tremendous force that will accelerate what we are calling this the Industry 4.0 revolution, change our lives in ways we may not even be able to imagine. Now, of course, the recent volatility and churn in market winners and losers, it gives us a pause, but it also highlights the need for investor precision and selectivity. And that's what you solve for when you invest with seasoned portfolio managers such as Pri, Clayton, and Pranay, who invest in sectors that are at the frontiers of the AI investing theme. So Pranay, Clayton, Pri, thank you for sharing your expertise with us, and thank you all for attending today's webinar. If you're ready to continue the conversation, engage, discuss additional resources, please reach out directly to your Fidelity representative. We hope the information presented was useful to you. I again encourage you to fill out the survey using the event survey button. Related resources will also be available on the event page. And with that, thank you all and have a great afternoon.